Should I say good morning, everyone? Let's see if everyone is awake. All right, no, good afternoon, everyone. My name is Raghuveer Vinukalu, and I am absolutely honored to lead this panel today, which will be focusing on insurance and local government financial needs. I think, Kate, following you, I think we'll need a lot of magic wands for this panel. Yes, but I will have that towards the end, just FYI. I have three panelists today. Let me introduce them with one sentence for each of them. We have Penny Leo. She's from the Resources of the Future. I call her, she's going to be the navigating fiscal turbulence with a smile. That's what she'll be focusing on. And then we have Shane Kavanagh. He represents the Government Finance Officers Association. He will be the rainmaker, mastering rainy day funds and self-insurance with a chuckle. Yeah. And then finally, we have Katie Sarbo from Aon, who I call her as a partner in crime in the industry for what we do, but let me call her as the disaster dollar guru, who is making insurance for public entities hilariously interesting. So with that, I'll just have a couple of disclaimers. If I don't stop talking, blame it on Zach. He told that the moderator's discretion. If I have a moment of silence in between, that's because there has been absolutely amazing information throughout the day. So that's because I'm just processing the thoughts, right? Acknowledgements. Well, Carolyn and Helen, really, thank you so much. Just, I was talking to Tom Glassick outside. I mean, pulling together something like this is already amazing, but pulling together these people on a Thursday and a Friday of a week, that's great, unbelievable. So thank you so much again for having us. I do also want to acknowledge, again, there have been some comments about some of the activity that have happened in the last 2 weeks, especially a big kudos to FEMA and RAA, especially focusing on this particular panel. The CDRC is just an unbelievable step forward, and recognizing them, the 474 as the initial communities, I think that's great. So we can come up with some pilots hopefully soon. Huh? And also, we have some panel members here with Deborah and also Deputy Commissioner Mike Peterson. I do want to also give a lot of kudos to them in terms of the leadership California has shown on climate risk and insurance, so with Commissioner Lara Sleet. So when I started thinking about this panel, I mean, of course, working for Munich Re, and also, by the way, I do also want to say something about I'm also another displaced hydrologist, followed by Joe, right? Who he was also on the panel. So we have two displaced hydrologists in the room and in the reinsurance industry. So with that, let me. So some of the things that we think about every day is disasters, right? So when we talk about 2022, I do want to talk about some numbers, right? The big number in question globally, what would be the overall economic losses? $270 billion in 2022, right? And of that, I think less than 50% was insured. And we would have thought that's globally, okay. What does that look for the US? And one big event that comes to mind from last year was what? Hurricane Ian, right? And Hurricane Ian crossed about $100 billion of losses, economic losses. And we would have thought that, well, in the interest of the protection gap that we talked about in the previous panel, I would have thought that in the US, we would have at least crossed 70, 80% of insured losses. But that number was about 55% insured, 45% still uninsured. When we talk about protection gap and some of these events with climate risk, I think there is one event that is very close to heart, which is the 2019 Mississippi River floods. It's a very, very important event to think about. $25+ billion of economic losses. And now if I tell you the insured losses, you would actually be like, are we serious? That was 200 million, right? 25 billion, 200 million. Shows that the center of the country, the Mississippi River basin, sorry. So, and just another fact that I found out about the Mississippi River, it actually, the 95% of the US exports touch the Mississippi River. And this is the corridor we're talking about where the protection gap was less than 1%. So what does that all lead to? I think I would say a quote from our Chief Reinsurance Officer: climate change is taking an increasing toll. The natural disaster figures for 2022 and also the previous years are dominated by events that, according to the latest research findings, are more intense or are occurring more frequently. So frequency and severity. In some cases, both trends apply, right? And another alarming aspect of what we are witnessing time and again is that these natural disasters hit people in poorer countries and regions across even in the US, in the vulnerable populations. Prevention and financial protection, for example, in the form of insurance, must therefore be given a higher priority. So that's something we definitely believe in. So before I go to the panelists, I do want to say there are some reflections from throughout the day. I call it making insurance sexy, right? Because insurance, we also have to talk about insurance to the upcoming generation and the students. And sometimes when we talk insurance and say insurance, then it becomes really boring, right? So I like to say there are 3 aspects of insurance, which was all brought up today. I think, Joe, you also brought it up. The first bullet point is risk education and communication, right? The second one is risk management and mitigation. And the third one being the risk transfer. See how amazing it sounds. Much better than just insurance. So I really hope that that's what we as an industry start using this, because I think that makes a huge difference. We make a huge difference in terms of what we offer to the communities. And then I also want to bring up one article that Alice Hill wrote recently, which is on climate change and US property insurance, a stormy mix. And I think one aspect of it, which was really interesting, and I also put it on LinkedIn, which in one of the section, what should be done? I think she really puts it very crystal clear. And while every point was important, I personally liked one which I want to underscore, which is encourage best climate practices among insurance companies and regulators. So climate change requires working across silos, but we need to be able to not just communicate the risk, but also the impact of the changing risk with all the stakeholders, right? And so we have to work across silos, and this is the perfect panel to discuss that, right? So going to the panelists, I'll start with each one of you. Let's go left to right, but I know we're going to talk about the different aspects of this panel, but let's just start with one takeaway that you got from today all day, right? So that we can wake everyone up. And I know we're just holding them from the drinks, right? So we have to make it.
Absolutely no pressure, right?
Yeah, no pressure.
Okay, so my one takeaway from today has been that we have underscored that there's not one industry, firm, state, or local government that's going to solve this problem on their own. And I think that's a big component of why everyone is in this room today. My lens is, I work with state and local governments, I work with disaster recovery funds, and so what I'm seeing is, as insurers are exiting markets, as FEMA's disaster recovery fund is already in this kind of precarious state right now, navigating its own fiscal issues, we really need to move to that line of sight into, what Joe and that kind of that back table back there said is, we need to go to proof of concepts pretty quickly. And that's really, really important. There is so much to be solved for that we just need to start doing more of these funded, sustainable proof of concepts.
Right. Thank you, Katie. Penny?
My one takeaway is actually quite related, which is that I find it super exciting to see all these proposals for innovative new insurance solutions to try to speed up the distribution of funds to provide them to people who are in need quickly, and then to ensure that we can increase coverage of the vulnerable. And so I'm super excited about the prospect of the research community further engaging in this space to help test out some of these solutions and to think about how to make them more successful and to scale them up.
All right, so a theme that's resonated with me is this idea of what I'll call accessible and actionable data that has come up quite a bit. This is that local actors need better data to make decisions. Sometimes it's actionable but not accessible, and other times it's accessible but not actionable. And I'll give you an example. So working with the city of Berkeley, California on their reserve strategy, and the emergency manager there has been palpably frustrated by the we'll call it the great amount of accessible data about tsunami risk, but it is not actionable because she can't make heads or tails of it. So and then I think it was brought up earlier, maybe it was by Francis, if I'm remembering, in our first presentation or near the beginning, where he said, well, insurance companies have a lot of really good resources, but it's not accessible, right? So one of the things we've been working on with Aon, which we'll hear a bit about later, is bringing their data models down into local decision-making, and those are quite actionable because they're very specific about the local impacts of these potential catastrophes, but traditionally they haven't been accessible. So how do we have both accessible and actionable data?
Great. Thank you. So getting into the panel and really the discussion about what the local government needs are. Penny, I know that you've led some of the research and some really interesting papers recently and I think one of them you partnered with Carolyn. So tell us a little bit about what were the findings, especially focusing on the impacts on floods and hurricanes, but also focusing on a separate paper on wildfire for these communities, right? And yeah, so just maybe specific to some perils, but what are also some common insights that you found?
Yeah, thank you. So I've worked on 2 studies measuring the impact of the fiscal impacts of disasters on local government budgets. One is looking at how wildfires affect California municipalities, and the other one is looking at hurricanes and floods, how these disasters affect county government finance nationwide. And basically, we are able to look at detailed budget items to try to capture all the different ways that disasters can affect the different components of the budget. And the overarching finding we are looking at is that disasters make it really difficult for local governments to balance their budget. And that is because the primary effect is that it just places a significant demand on increased spending right after the disaster. And those will be on things like recovery and adaptation spending. For example, in California, we find that having been exposed to a major wildfire, municipalities on average increase their spending on community development by 40%. And they also increase their spending significantly in terms of public safety, transportation, and things like preparedness. So that's like the big demand on spending. And then on the other side, revenues usually do not keep up with the spending. In fact, disasters, as we know, create damage, and that damage can reduce the tax base of communities in the short run. And then in the long run, if people start migrating away from these communities, then they can have erosion of the sales tax and property tax base as well. The local governments have some ability to respond to the increase in spending by trying to raise funds through, for example, increasing functional taxes, which are taxes that are linked to specific purposes, such as rebuilding. They can do that through voter approval and things like that, but some communities are limited in that ability, especially lower income communities. And then the other sources of funding they can get is through intergovernmental transfer, which are funds they can get from state government or federal government in the form of disaster aid. And there, again, we also observe that there is sort of like uneven distribution where higher income counties tend to get more intergovernmental transfer following a disaster compared to lower income counties. So in general, we see that the ability to raise additional funds or the impact of disasters on revenues makes it very difficult for local governments to fully compensate for the increased spending they need to pay for after the disaster, which means that they will need to start drawing down on their reserve funds or rainy day funds, or they will need to borrow more. And my papers do not explicitly address this, but some other studies show that borrowing costs could get higher if a government is hit by a natural disaster, or their credit rating can go down. And so in the long run, this would also create further fiscal stress. And so that's essentially sort of the big picture of what we find.
That's a lot of information packed there, but we'll get back to that. But let's move now to Shane. Shane, as I talked about the 2019 Mississippi floods, one of the things that I found with some interviews from mayors was when the disasters were happening, some of these communities, some mayors, they said, we don't even have $25,000 in our bank account where we can, and in this particular example, it was like they wanted to rent a boat to get the emergency professionals to the other side so that they can mitigate some disasters. So your work focuses on the opportunities that local governments have, and that they can focus on getting the best values from their reserve strategies, correct? So, so I know that you had you were thinking of getting some AR goggles so that you could present some stuff over here, but I'll move it to you too. Who here agrees that should be like there should be a science fiction insurance movie where he should be there? All right, Katie, moving to you. Especially, I've heard a lot about the work that you do with public entities and the role of the insurance industry. Before you move to the solutions, what are really some of the challenges that you've heard from these public entities? And of course, then you can move to the solutions, the amazing, brilliant solutions that we have. Because as I always say, as an insurance, reinsurance industry, we are always full of supply, right, in terms of the products, but the demand is what we really have to address. So where was that intersection?
So in order to just keep it simple, I think the biggest challenge I hear time and time again from our clients is access to data. And not in a way that they don't have it. There's almost, it's analysis by paralysis almost at this time. And so in working with Shane and GFOA, what we really tried to do is, to Carolyn's point earlier today, can we democratize a little bit of this information to make it actionable? What we want to do is really help governments think of themselves as insurers. I don't know who mentioned it earlier, but we're moving from this kind of conceptual insurer of last resort mentality to a very, very real scenario in which our state and local governments are going to end up taking on an exponential share in the losses post-disaster, especially as we see insurers leaving markets. And again, and FEMA, who is the Disaster Recovery Fund is a completely supplemental program, but we talked about Congress earlier. It was completely contingent on it being funded. So what we're trying to do is create a robust decision-making toolkit so that our risk managers are connected with our chief budget officers. They're having, our risk managers know exactly how much is in reserves when they're making their decisions. That when we think about buying property insurance, we're really thinking about it in this lens of how much should we buy, what should we be buying, and can we prove it out through, a tool like Shane's to really put some of these risk-based analysis conversations to work, because it absolutely matters when you have a zero-based budgeting plan. Every dollar has to be accounted for, and there has to be a linkage between where funds are going, because that $1 that might go to insurance could be a dollar that doesn't go to teachers or public safety. And so we really need to get better at using tools that provide this more empirical view of risk at the state and local level.
Great. That's interesting. As I said, I'm still processing. But before I get there, I have one more question for you, Katie, and then I want to also tie this to you, Penny. When we talk about public assistance, something that comes to my mind is, again, in the context of the 2019 floods, but also almost, Puerto Rico is another example with Hurricane Maria, and then other Hurricane Harvey and other flooding events. There's sometimes, there's a long delay in terms of this funds reaching the local communities, right? And so I think the flooding events from 2019, the funds received by the local communities were in 2022, early 2022 or late 2021. So how would this delay affect the resiliency of these communities and especially with your research on the fiscal impacts? And of course, also highlight the importance of this, the ex ante measure versus compared to the ex post, right, which is pre-disaster and post-disaster.
Sure. So as I've described before, typically disasters trigger a very big need for liquidity for local governments. And an important source of funding for that liquidity is intergovernmental transfer, public assistance, in order to repair. Oh, it's hard to hear. Okay, is this better? Yes. Well, so I was just talking about public assistance is a really important source of liquidity for local governments following disasters to meet their needs to repair damaged infrastructure and public buildings. If they don't get that, like because those fundings are delayed, they are very constrained, right? They can delay their recovery, which is definitely not ideal, or they can use other sources of liquidity, such as drawing down reserve funds, such as borrowing more, and they can also cut down on other services that they're providing, which a lot of them are essential services that you don't want to cut down on. But in my research, we can see that lower income counties typically, their spending after disasters do not tend to go up a lot. And their revenues also, they have very limited ability to raise revenues, so they are really constrained. And so this is actually a pretty big problem for them. And I think that on the point about ex ante versus ex post preparations, this speaks a lot about financial preparedness. Like we talk about communities making preparedness plans for disasters. A lot of them have to do with emergency response, but it's also equally important for local governments to think about whether they will have that source of liquidity, whether they would be financially prepared. And so I think that this directly speaks to, whether they have the ability to build up rainy day funds. And if they're not able to self-insure, then it's very important for them to tap into insurance as a solution.
So Shane, taking that forward, and is there any examples of cities, or, I mean, I know there's rainy day funds for states, but tying into what Penny mentioned, how do these local governments, is there any good examples where they have balanced between self-insurance and the commercial insurance that you talked about?
Good question. So it's a very heterogeneous group, right? You imagine there's tens of thousands of local governments, so there's no such thing as like the average local government, right? They're all quite different. But I would say someone we're working with right now who's very interested in this topic is actually Salt Lake City, Utah. I think if I'm correct, if I'm wrong, Katie, but Utah State was the first parametric really in the entire country, for earthquakes, if I'm remembering right. So they have a very good example in their own backyard. In fact, they're quite interested in learning from the state in terms of what the state has done with parametrics, and they're also quite interested in optimizing their own traditional insurance policies with their self-insurance policy. So I'd say they're probably on the leading edge of the different local governments that we have worked with to this point, but there's also some others that are doing some good thinking around this in other places as well.
Great. Katie, I think this all ties to one thing that there is a report that you have kind of contributed to, but I think it was a report by the RAND Corporation on insuring public buildings, contents, vehicles, and equipment against disasters, right? I think one of the co-authors is here, Noreen. Where are you? There you go, Noreen. You want to highlight some of the things that I think this was a very comprehensive report but what really stood out for you?
It's such a fantastic report that Noreen, I mean, it was 300 pages, right?
But we could also call Noreen to talk about it.
You should come up and
kidding.
talk about it.
Just kidding.
It's your report. And so, yeah. Yeah, so what Noreen just said was the major takeaway of the report is FEMA, should be there for severity events, right? And the frequency events are really borne by state and local budgets. And what we're starting to see more is, there's there are two critical paths, right? Figuring out the frequency events is absolutely something that we need to start tackling. Again, I think it's hard to separate the two because if you work with Shane, you really start thinking about the frequency events from a budgetary standpoint and then thinking about risk transfer for severity events. Because insurance is really not going to be a really good tool on frequency when you're thinking about budget efficiency. It's really a severity tool.
Yeah.
And so I think that, Noreen, is a really good point. But it's a fantastic report. If you haven't seen it, I would definitely recommend it.
That's great. I think I wanted to highlight that because I think it would be really recommended to everyone. But on that point, Katie, I think it's really important to note what really insurance is, right? I think there's one point I always make about insurance. If we come back to the basics of insurance, there has to be, really the challenges from a climate risk standpoint. Insurance is not for frequency events, and that is one of the things that's sometimes lost in terms of communicating the impacts or the benefits of insurance to people. It's really for the unforeseen events. And when it comes to insurance and what is behind the premiums, I think there are really complex models out there, but what's the two variables which really drive the premium, which is the average annual loss and a variance around it. Average annual loss, what we have seen in the last 10 years, 20 years in the history, which gives a sense of what we can expect on an average basis. Of course, the contract is for 12 months, right? But what can we expect on an average? But there is also a variance. There's a standard deviation, which is basically saying what's the variability that we have seen in terms of what's the smallest event, what's the most extreme event, something like Hurricane Harvey or something. And while the average annual loss really contributes to the premium, the standard deviation can make a huge impact on the premium. The higher the standard deviation or what we call it as uncertainty, the premiums can be really high. And what risk mitigation does is really remove that frequency event, which is where most of the uncertainty is. So that's why it's really important to make sure that we tackle the risk frequency events with risk mitigation. I think it's coming time to get to that magic wand question. So I'll give you guys like a few seconds before we get there. But I thought to wake people up, I used ChatGPT, and I said, all right, let's see if we can wake people up. And I said, let me put some stuff inside and create a poem for this amazing group. I'm not a poet, but the first paragraph is this, and I'll come back with others later. When property owners, nonprofits, governments unite, adaptation to climate risk takes flight. With a shared vision, we stand tall to protect our world for one and all. All right, so let's start with that. Woke up, right? Everyone is awake? Perfect. Katie, with your magic wand, but in this particular case, I'll ask you to say, if there was one product that you would think would really help in the near term for all these local governments, what would that be?
Hands down, parametrics. The critical point is how they are deployed, and there are really 4 different ways. They can be, and they're not, this is not exhaustive, but I think the 4 ways of deploying a parametric product for state and local governments are within property insurance programs, as part in combination with traditional indemnity products, complementing property insurance programs to cover non-property losses, so sitting outside of their property programs. That specific use would also complement FEMA disaster recovery funds. Third, using it to reduce obtain and maintain requirements from FEMA. We just did a product and placed something with Puerto Rico. It was the first of its kind, and I do think that there are other ways of using it. And the fourth, and this is more pie in the sky, magic wand, but I could see a world in which FEMA provides a subsidy to the state and local governments that are disproportionately impacted to purchase a parametric product to offset some of the post-disaster costs borne by FEMA and the government itself.
Well, since you talked about a little bit of the innovative solutions here and parametrics, some part of the poem also is coral reef insurance, a novel sight, protecting ecosystems shining bright, with CBCI communities unite, building resilience like a guiding light. Right? With that, Penny, what if there was the next paper that you would want to work with, well, whether it's with Carolyn or anyone, what would that focus be? And if you wanted a positive outcome with what would that be based on what communities could do?
Yeah, so being on this panel and listening and learning from, my co-panelists, I think that the question I really want to work on is to identify sort of the welfare impact of having quick liquidity in a post-disaster scenario. Like how does providing liquidity affect the welfare of residents who face damaged properties and the community relative to the counterfactual, which is the current model. If we can find a way to measure that, that would be really valuable for, arguing for further deployment of this kind of insurance or rainy day fund models.
Great. Well, we're looking forward for that paper, right? And, Shane, your magic wand with
No poet?
No, with unlimited power, because you are the.
All right. Well, I'm going to flip the script a little bit, and I'm going to make your dreams come true. So the question is, what can GFOA do for you, right? So a couple thoughts is, number one, a couple people have asked me about this already, so I'll extend to the rest of the group. we could get a group of forward-thinking CFOs as focus group to think about how local governments may be, what's the word, better approach the types of instruments that folks are talking about in this room. So if that is attractive to you as an option, let me know. Number two is this idea of open and accessible data. So you've heard we're working with Ann. We're actually also working with First Street. So we just recently built both a heat model for Berkeley and a flood model for Salt Lake using First Street's data. So the idea of contributing to open and accessible data is something that interests you, do get in touch. In fact, we are doing a wildfire symposium with Pew Trust next month. We are bringing together a bunch of data experts in the world of wildfire to start to actually build these models out. And we've already got one demo model prototype ready to go. And the idea is we'll then take it to actual local governments to get their take on it. And then the maybe third idea is GFOA annual conference is in Florida this year, in Orlando. We typically get between 5,000 and 10,000 CFOs at this conference, and would be very interested to talk about insurance models and for hurricanes or other relevant risks. So if you would like to talk to local government CFOs, a couple hundred at a time, about this topic, do let me know, and maybe we can work something out.
Great. There was one thing that I was thinking about, and maybe Katie, I can bring you back in, which is, I say that the big elephant in the room and still is, and I wish I had the magic wand, which I could have used in this case, but Stafford Act. How's that benefiting or not benefiting, and I mean, especially some of the events that are happening in terms of the increasing frequency. What insurance solutions can supplement or kind of work around that? So that I don't want you to go into the political aspect of this, but yeah.
Wasn't going to.
No, just kidding.
So it would be the second bucket of deploying a parametric product to complement FEMA disaster recovery funds. What we have found, and a few people have mentioned it today, is really if you remove that lens just on property losses and you think about municipal and state budgets as a holistic risk management strategy, putting a parametric to complement and sit next to disaster recovery funds that do exactly what parametrics are designed to do, really quick infusion of liquidity for those post-disaster immediate needs that essentially does not need to be exhausted before you can access disaster recovery funds, I think is one of the biggest tools state and local governments have right now to manage not only their post-disaster costs, but really also start thinking about pre-disaster mitigation. And really quickly, the combination of the two is important because we are, and Shane's data supports this, we are saving so much for an unknown event, right? There's not a lot of actuarial analysis going into what we reserve for or save for. So instead of sending, $200 billion in a reserve fund, we can really look at that and use that to not only fund premium, but fund mitigation and adaptation.
Great. Well, I think that's been one of the last point that you said about the funding mitigation and adaptation. I think my last comments would be, and then I can open up for questions to the audience. I'd say as communities, I think there is a lot of framework in terms of addressing the physical resiliency of the communities, which is the risk mitigation and so on. As insurance or risk transfer as a good solution to really, the risk mitigation can help with the frequency events, but financial resilience with some kind of a risk transfer for addressing those extreme events will be something that these communities should focus on. With that, I'll open up for questions. If you don't ask questions, I'll have to read the rest of the poem. But Helen, please.
Absolutely happy to do it. Puerto Rico was given the ability through FEMA to use a parametric product on a hybrid standpoint to fulfill or reduce their obtain and maintain requirement. The obtain and maintain requirement by FEMA is what state or local government is required to buy after FEMA has already reimbursed them for a disaster. So Puerto Rico has upwards of a $2 billion O&M gap, and FEMA allowed them to explore parametrics. So we were able to place a multi-peril parametric product for Puerto Rico that will go directly to reducing the O&M gap if it is triggered.
All right, well, this is actually a fairly interesting development that happened quite recently. The latest data sets that Ann gave us include economic loss as part of the data, which so that takes it beyond the direct loss to the local government and opens up the possibility to think about how different strategies might impact the folks outside of their jurisdictional boundaries, right? Because like anybody, local officials have limited time and energy and just ability to think about the world. So to the extent that we can expand the scope of these models to show what sort of impacts their choices may have beyond their own kind of corporate entity can be quite valuable. So I'll give you an example, right? If you build any kind of mitigation, right, there's going to be a direct impact on the local government finances, but that impact is actually going to be quite small. And if you compare to the cost of building the mitigation, it's going to be a financial loser. But if you include in it the broader impact to the community and other interested parties, it may very well become a financial winner, right? So having the data to be able to judge that, I think, is very important, and we are headed in that direction. In fact, City of Berkeley, we're doing that right now with them, and they're kind of building this sort of information into their most recent version of their emergency management plan.
And I would follow up on Shane's point, Rob, and just say, I think the idea is to keep it as simple as possible. And even if it's a complex matrix of who owns what, there are still net losses to that specific governmental entity that can almost be thought of on its own, right? And so just because a governmental entity purchases an insurance product or a risk transfer product doesn't mean that hospital system can't, right? And I think it's really having those conversations, especially within a certain proximity, that really matters. Yes, correct. And the answer is no, because in the Stafford Act, it's written, it's one of the many things that should be updated, but within the Stafford Act, it is insurance not otherwise legally required, right? And so because it's outside of that, there is no recourse for FEMA to touch those insurance proceeds. So think about like a cost share that's absolutely borne. It's already listed in the Stafford Act as things that FEMA has automatically said they will not reimburse you for. Losses to revenues and fees, increased operating costs. So those are, when we think about putting and deploying an insurance or a risk transfer product, it's important that we make sure that everyone understands the intent of the product and the payout. And so when we think about that second bucket, it would really be used to complement, and the state and local government would be held harmless from any having to hold it or use as retention before disaster recovery funds kicked in.
One final? Oh, sorry, okay.
I'll answer part of that question. So part of it is the capital question, and of course, the debt is the traditional answer, right, for any kind of large-scale capital project, but something we're doing right now that we have an incubator happening for is called an Urban Wealth Fund. Show of hands, Urban Wealth Fund, anybody? Nope, so basically Urban Wealth Fund works like this. Is you've all driven through a mid-sized city where you kind of pass a tall building, pass a flat parking lot, pass another big tall building, pass another big tall building, right? Who owns that flat parking lot? Municipal government, right? The dirt underneath that parking lot is the same dirt underneath the big tall building, yet what's on top of the dirt is severely underutilized. So the idea behind an Urban Wealth Fund is identify these properties, which there are many. And then number two, identify the market value, which is usually totally unknown. and then figure out how to leverage these assets better for potential uses. And I'll give you an example to your question is Anne Arundel County in Maryland is in the incubator, and they are doing this specifically for identifying capital for climate change. And actually, Anne, there was an Anne connection when your colleague Michael came, so maybe you'd want to say a little bit about, or I'll leave that one to you. I don't want to steal Anne's thunder, but anyways, the idea was the question that came up in our conversations, hey, we are building these things, like is there a possibility to have a sort of, we'll call it like Sharon savings model with insurance companies, or if we build flood mitigation project XYZ and that results in lower insurance, can some of that saving be used to to help fund the project? So let's ask our friends at Anne. So we came up with here's this brilliant idea, and they're like, oh, we're already working on it. So Anne has a pilot project that is going in this area, and Katie, if you want to say any more about it, or if you want to defer to later, I will leave that to you.
Yeah, I just looked at time. What I can do, Ben, I can find you afterwards and give you some more information, but it's easily a 10-minute answer.
Yeah, I do want to quickly point out that I think the Climate Policy Initiative did mention some of this is as these capital-intensive projects happen, they recommend that the cities work with the insurance industry to evaluate the impact of some of these projects on the insurance premiums. And one such example, which is in place, is the Broward County, I think, resilience plan, the countywide resilience plan. So I'll just highlight that and say that something really amazing that they are doing, so which I would like to highlight. One last question. Yeah.
I guess the short answer is, you know, and Franson mentioned it earlier, it's difficult, right? You guys there's nothing out there that you guys are missing. We are, for an insurer mindset, there is that 12-month kind of cycle, right? And it's really difficult to capture savings with this kind of growing increase in risk, right? And rarely is there enough of a delta that you're going to see an impact in a short-term environment. Now, with that being said, in the longer version, what we can talk about afterwards is that there is potential to get there, though, and I think it will take more conversation. But the shortest answer for everyone in the room is it's difficult and slightly non-existent in this moment in time.
Great. All right. Well, last 2 minutes, so one question. All right.
Just very quick, I actually think we're missing something.
I'm definitely not an expert, Calvin or anyone. Well, thank you. I'll put ChatGPT at work. So, anyways, but thank you so much, Katie, Penny, and Shane.